We're joined by Lily Fang, Assistant Finance Professor at INSEAD and co-author of a paper that's won an award, the Smith-Breeden Prize, as a distinguished paper, and the title of the paper is Media Coverage and the Cross-Section of Stock Returns. So is no news good news?
In some sense, yeah, you can sort of think about it that way. And originally we were actually toying about the idea of whether we should title the paper such as something like, along the lines of no news is good news. So clearly the good news, actually we decided not to go there because it depends on which perspective you're taking. So the paper, what we're actually finding is that when stocks don't have media coverage compared to stocks that have a lot of coverage, and you obviously need to control for a lot of underlying things such as company size, book-to-market ratios, and momentum. And we control for all the standard other type of risk factors, and we find that the stocks without the media coverage earn higher returns. So this is good news from the investor's perspective. So if you seek out, obviously these stocks with no media coverage, they are sort of hidden gems. They're not very obvious, not on people's radar screen. So investors need to do a little more homework in terms of kind of seeking them out. But if you do so, you seem to be able to earn significantly higher returns than simply, buying the things that are flashing up on the Bloomberg or sort of high on people's radar screen, those type of stocks. So it's good news from investors' point of view. However, it's perhaps sort of not so good news from the company's perspective, because obviously return being high means that upfront, ex ante, your prices are slightly depressed compared to other stocks.
So from your paper then, it seems that some stocks have higher returns of up to 12% a year, which is significant.
Our sample is mainly very large NYSE type of stocks. So to the extent that, after you control for all these factors, you still find something related to media, it's already quite something. And overall sample has something like 3% to 5% return controlling for everything else. However, if you subdivide the sample further by size, you would find larger impacts for the the smaller set of this overall sample. Although, with as I said earlier, our overall sample is already very big. So the smaller third of this sample actually finds a 12% return between the return difference between stocks that have coverage with no coverage.
The research covered a 10-year period, and you were looking at all stocks on the New York Stock Exchange plus 500 randomly selected stocks, NASDAQ stocks. And as you say, the smaller stocks are the ones that did particularly well. From an investor's point of view, though, it almost seems as if you should watch the TV channels, try to see which stocks are being highlighted, and then choose other ones.
So that, yeah, in some sense, that's sort of what we're saying, and also, I can't say that we're the only ones who sort of say these things. I mean, there has been in the 80s, there has been a paper has been around a long time called Giraffes and Hidden Gems. So giraffes are these, obvious ones, very tall, hitting on the tall tree. So they're talking about sort of these obvious targets, whereas hidden gems. So we're sort of along those lines. And sort of 20 years on, people would, you'd have imagined that the market being much more efficient and these type of anomalies would have been, dissipated, but, it's still there.
Small stocks generally would see greater volatility, though.
It's true. So it's very, very important for us to, number one, so we actually had to be really, really careful that we're not just documenting a size effect, because size alone would predict returns. You have small stocks outperforming large stocks. That we know for a fact. So therefore, we need to actually show that our result is sort of orthogonal to this, which means that even keeping the size constant, a similar size company, one with media, one without, there's a difference. So we need to have this, multiple sorting where we control for these other elements. And you're right. Also, precisely perhaps because small stocks are ultimately more risky, and one of the indications would be sort of higher volatility, they would also get higher returns. But again, like I said, we sort of have to very much be careful about controlling for these other effects.
So companies then should be looking at increasing their media coverage in order to get the stock price up, even though that may mean a lower return.
Yeah, that's actually kind of an interesting thing that is an interesting implication that comes out of the paper. As I said, without media coverage, no news is good news for the investors, which means you earn higher returns. But if you turn the perspective around to look at the company's perspective, it implies that their stock prices are slightly sort of depressed because they are lesser known. And I think companies are in fact we're well aware of this. I mean, they actually didn't really need us to write a paper and to tell, but I think our paper just really kind of validated their concern. And we know that after Sarbanes-Oxley and a bunch of stock market regulations that happened in the beginning of this decade, around 2000 to 2003, one of the sort of the perhaps somewhat unintended consequences was that a lot of analysts left the profession and leaving a lot of companies without any analyst coverage. So we know that traditionally analyst coverage is very important in terms of disseminating information, put the company out there, letting investors know about them. And this triggers liquidity, this increases the company's visibility, and essentially our paper is showing that this has a price impact, right? It allows the company's price to be more efficiently priced, because ultimately at the end of the day, if you want to relate to theory, it means that if your company is out there and known, people need to know about your stock in order to actually invest in your stock. So if your company is never really known, right, then few people will hold it, and these people are not going to be in the theoretical world sort of having a diversified portfolio. So their risk premium will, for the stock will be high. And so therefore, any kind of thing that helps company to actually raise their visibility would have an indirect impact on their cost of capital. Again, we're not sort of reinventing the wheel. These arguments has been around for a long time. I think that we sort of benefited from the fact that we had a unique data set using media coverage, and normally you wouldn't think things that get printed on the Wall Street Journal would affect market, because market participants have a lot of other sophisticated access to information. But what we really showed is that it's not really sort of the news content per se. It's sort of not the actual reported events. It really is awareness, a company being known to the investor. So it's a visibility issue.
What should companies be doing then in terms of cost of capital? This is something that companies, I think that they are aware. They are increasing these kind of efforts to let their company be more visible, and especially, and I think this is important, especially in the after Sarbanes-Oxley and global settlement period, where even some S&P 500 large companies lost their analyst coverage. And so essentially we're saying that for companies, they could think about using media outlets coverage as sort of a dissemination tool. It would not completely replace the lack of analyst coverage, because the analysts provide more to even sophisticated investors, but the media coverage is certainly a can be partially sort of helping with that lack of coverage. Lily Fang, co-author of a paper on media coverage and stock prices. Thanks for joining us.
Thank you very much. Thank you.